Look, I've taken another look at the electricity sector ahead of full-year results. I've reviewed some of the assumptions I've made previously with regards to retail pricing and the impacts of retail customers struggling to pay their bills. I'll just touch on the high-level points. So first of all, I wanted to dive into the disconnect between falling wholesale electricity prices but fairly stable retail prices. And what I found when I looked at the energy costs for an average retailer to supply its customers, and so this is not the base load or the peak price, but the demand weighted by half-hour periods, average price based on the retail consumption. And what I found is that for most times of the year, there is only a small premium to the base load, so in line with peak prices. But there are occasions where that premium really blows out and shoots higher, and that poses an additional risk and therefore cost for retailers. As I've commented previously, cap prices haven't been falling, and in fact, if anything, there's been an increase in March quarter volatility in New South Wales and Victoria. And cap prices are one of the key instruments that retailers use to hedge their exposure to volatility. So what this means is that I don't think big retailers like Origin and AGL are going to face a lot of pressure to further reduce their retail prices short of direct intervention by the ACCC. So we have seen the long talked about big stick legislation is now in force, but at the moment I don't think that's realistic. That's certainly not my base case. Another issue worth noting is that the AER has actually done a pretty good job of tracking debt and payment plan statistics amongst electricity retailers. And what they've found so far is that there hasn't been a noticeable uptick in debt amongst household customers. Now this might be because some of the retailers are offering deferments of payments into July, which therefore doesn't match the formal definition of customer debt. So there might be an uptick in those numbers this year, I should say. But I have adjusted my assumptions downwards. I think they're probably a little bit too aggressive in light of that data. So what this means for investors is that for FY21, I think for AGL, there's going to be a solid year for earnings, and I'm forecasting a dividend yield of 6%. I don't think the long-term issues have gone away, though, unfortunately. So I'm comfortable keeping my rating as a hold, but I certainly don't see any need to panic and sell out of the stock. For Origin, the oil price will dominate the share price performance. And if you look at the performance of Origin in relation to the energy index, it's being traded much more like an energy stock than a 50-50 retailer and gas producer. So I do have concerns about next year's earnings, given the very weak outlook for APLNG, given the weak outlook for oil prices. But I'd say over the medium term, when we do eventually see a recovery in oil prices, that will be very positive for the share price. So I've retained my ad, but I'd say there might be better buying opportunities after the result. I should note that my FY21 earnings forecast for Origin is quite a bit lower than consensus. I really struggle to see how earnings aren't going to take a massive hit, given that Origin is looking to retain production. So I don't think that cost base is going to move too much, while obviously revenue will be down quite significantly. On Infigen, no real change there. I think the on-market premium on the leading takeover offer is pretty compelling. I think we're probably getting pretty close to the end of that tussle between the two bidders. So I'd say that on balance, I'd probably, if you have any holdings remaining, probably sell on market for the most of it, but maybe keep a small position just in case there is a last minute increase from UAC.